Hey guys, if you're heading to university either in the next few years or maybe you're already there, I wanted to put this video together for you to talk about how the HECS and HELP loan schemes work. So if you're not aware, HECS and HELP is a government-funded loan scheme to help you pay for your university courses. It's not a bad loan as far as loans go, because when you take on a loan to invest in your education, you're basically investing in your future ability to create income, which is actually a good thing. So as far as loans go, now as you know, don't like any loan really, but as far as loans go, this is a pretty good one. So let me take you through how it actually works. Firstly, when you're applying for your university courses, on the forms there will be an option there that says, do you want to pay for this using HECS or HELP? And you simply just tick a box and off we go. Of course, that money needs to be paid back. And the big question is, well, what is the interest rate that the government will charge me on that loan? And the interest rate is basically 2 to 3%. But what actually happens is, at the end of June each year, which is at the end of the financial year, your loan will increase by CPI, so Consumer Price Index, which at the moment, as I said, is around that 2 to 3%, which really isn't that bad. That's less than what you would pay on a mortgage. So each year it will increase by 2 to 3%. How do you pay it back? What happens is it will be taken out of your pay when you start full-time work. However, you need to be earning at least $51,957 before they start taking it out of your pay. So when you go to your first job, they will ask you, there'll be a form that will ask you, do you have a HECS debt? You will tick yes. Your employers will then figure out how much HECS you should be paying based on your income. And then the ATO, so the Australian Tax Office, will check that at the end of each year to make sure that you've paid back enough HECS. But as I said, you do not start paying your HECS back at any point until you've started earning over $51,957. And at that point, they only take 2% of your pay. So if you're earning between $51,957 and $57,729, they're going to take 2% of your pay to pay back your HECS debt. Then if you're earning above $57,730, they'll take 4%, and then there's this scale that the more you earn, the more they take, down to where you get to $107,000. So once you're earning $107,000 a year, they'll take 8% of your pay. Until, of course, you've paid it back. So there we go, that's HECS in a nutshell. You can pay it off earlier if you want to, you can pay it off faster, and certainly if you have the means to do it, it's not a bad thing to do as long as you don't have any other debts, because if you've got any other debts, chances are you're paying more interest on those and you should pay those off first. But you can pay your HECS back early, because what will happen is when you go to get a home loan, the government will actually look at your HECS debt and they will include that in the equation and they will lend you less money as a result of that. So having no HECS debt isn't a bad thing, but you can pay it back early if you want to. So there we go, that's HECS. If you've got any more questions, remember our Money Monday. We're more than happy to answer them there.